The dollar is losing its weapon status, not because it's weak, not because America is collapsing, and not because another currency is ready to replace it. It's losing its weapon status because it was used to effectively, for decades, the dollar wasn't just money. It was leverage. If you wanted to trade globally, you used dollars. If you wanted to clear payments, you used dollar rails. If you wanted reserves that worked everywhere, you held dollars. That gave the United States something no empire ever had before: control without occupation. You didn't need troops, you needed access. And for a long time, that worked perfectly until the rules changed. Not officially, not overnight, but in practice, once assets could be frozen at scale, once reserves could be immobilized, once payment access could be switched off with policy instead of process, something fundamental broke. Not the system, the assumption. Because money only works as a weapon as long as everyone believes they'll never be the target. The moment that belief cracks, behavior changes. Quietly, this is where most people get it wrong. They expect a dollar collapse. They wait for charts to break, for inflation to explode, for some dramatic moment where the dollar fails. That moment isn't coming. Reserve currencies don't die in crashes. They fade through workarounds. If you close the main road too often, traffic doesn't riot. And the dollar is still the main road, but the detours are multiplying. This is why headlines feel confusing. The dollar still dominates trade. The dollar is still strong. US assets still attract capital, and yet, behind the scenes, something irreversible is happening. Countries are no longer optimizing for efficiency. They're optimizing for survivability. That's a massive shift. And once survivability becomes the priority, cost no longer matters as much as control. You saw this clearly if you paid attention. Assets were frozen. Not after trials, not after convictions. Frozen. And the important part wasn't who it happened to. It was that it could happen at all. You didn't have to agree with the politics. You just had to notice the signal. If reserves are conditional, they're no longer neutral. And if they're no longer neutral, they're no longer safe in the way people assumed. So behavior adjusted, not loudly. No country stood up and said, "We're done with the dollar." That would be reckless. Instead, they did what any rational actor does when dependency becomes dangerous. They reduced single points of failure. They didn't dump dollars. They added alternatives. Trade agreements quietly shifted to local currencies. Energy contracts included none-to-layer settlement clauses. Gold accumulation increased without press conferences. Reserve baskets widened slowly. Nothing broke. That's the point. If you were expecting rebellion, you missed the adaptation. And adaptation is always quieter than collapse. Think about how businesses behave when a supplier becomes unreliable. They don't announce it. They don't sue immediately. They line up backups. They accept higher costs. They protect continuity. That's exactly what's happening now. The message wasn't sent to one country. It was sent to every finance ministry, every central bank, every sovereign fund. Alignment now matters. And dependence is a risk. Once that realization sets in, the dollar's role changes. It's still used, but it's no longer trusted universally. And trust is what gives a currency power beyond its balance sheet. Now let's bring this to markets, because this is where people misunderstand the consequences. They assume a weaker dollar narrative. They expect dollar-denominated assets to suffer. That's too simplistic. The dollar can remain strong while losing influence. Those two things are not opposites. Strength is about demand. Influence is about obedience. The dollar still has demand, but obedience is fading. That distinction explains why nothing looks broken, yet everything feels different. Look at commodities. Energy still trades globally. Oil still flows. But pricing power is shifting back toward producers with physical control. That's why companies like Exxon and Chevron don't behave like purely financial assets anymore. They behave like geopolitical infrastructure. They don't just sell energy, they sell reliability. When trade reroutes, physical producers gain leverage. The same applies to mining giants like BHP and Rio Tinto. Copper, iron ore, critical metals don't care about settlement currency. They care about demand and delivery. As trade becomes more fragmented, physical assets matter more than financial promises. You notice this if you watched gold quietly move. No panic, no mania, just steady accumulation. Not by speculators, by institutions that care about neutrality. Gold doesn't freeze. It doesn't ask questions. It doesn't require permission. That's not ideology. That's function. This is why companies like Newmont and Barrick quietly re-enter strategic conversations. Not as growth stories, as insurance stories. Now, here's where most investors misstep. They assume this is bearish for US assets across the board. It fizan. The US still has the deepest markets, the strongest legal system, and unmatched capital pools. What changes is the premium on neutrality. Assets that rely on trust alone face pressure. Assets that function regardless of regime gain value. This is why defense contractors behave differently in this environment. Lockheed Martin, Raytheon, Northrop, their demand doesn't depend on global harmony. It depends on fragmentation. As the world splits into blocks, security spending becomes non-negotiable. Defense becomes a fixed cost, not a cycle. Shipping and logistics show the same pattern. Mirsky DP World. When trade routes shift, logistics providers, Dan Toulouse, really bond. They gain complexity premiums. Complexity creates margins. Now let's talk about what people who saw this early actually did. They didn't short the dollar. They didn't bet on collapse. They avoided dramatic trades. Instead, they removed fragility. You did that by not holding everything in one jurisdiction. You saved yourself from policy risks you couldn't predict. You didn't guess geopolitics. You just avoided single points of failure. You didn't sell US assets. You added exposure to assets that don't care where settlement happens. Energy, metals, infrastructure. When sanctions expanded, you weren't scrambling. Nothing dramatic happened in your portfolio. That's success in a world where drama destroys returns. Meanwhile, other people did the opposite. They ignored geopolitics completely. They assumed the system would behave the way it always had. They concentrated exposure in financial intermediaries that rely on dollar clearing. When rules tightened, friction appeared. Transfers slowed, compliance increased, costs rose, nothing collapsed, but returns disappointed. That's how regime shifts actually punish people, not with crashes, with underperformance. Now here's the hinge that matters. The dollar isn't losing relevance. It's losing exclusivity, and exclusivity is what made it a weapon. Once alternatives exist, even if they're inferior, leverage weakens. You don't need a perfect substitute. You just need an option. That's enough to change behavior. In the next part, we're going to go deeper into how this reshapes capital flows. Why emerging markets behave differently now, why certain banks benefit while others get squeezed, and how investors who understood this stopped trying to predict politics and started positioning for fragmentation. Because the mistake is thinking this is about America versus the world. It isn't. It's about systems adapting when neutrality disappears. And once neutrality is gone, everything reprices around control. Like, subscribe, and let's continue. By now, it should feel obvious that something changed. Not suddenly, not violently, but decisively. Yet here's the part that most people still don't understand. The dollar didn't lose power because alternatives became better. It lost power because dependency became dangerous. That distinction matters because it explains why the dollar is still everywhere and yet less feared. To see why, you have to understand what actually made the dollar powerful in the first place. Most people think it was size, or military strength, or economic dominance. Those helped, but the real power came from something quieter. Every global transaction had to pass through a narrow set of pipes. Dollar clearing, correspondent banking, settlement, systems. If you controlled the pipes, you didn't need to control the water. That's how leverage works. For years, no one questioned this setup because the pipes felt neutral. They worked for everyone, until they didn't. Once access to the pipes could be turned off based on policy alignment, the pipes stopped being infrastructure. They became leverage points. And leverage points invite avoidance. This is where the behavior shift begins. And it's subtle. No country says, we reject the dollar. They say, what happens if access is interrupted? That single question changes everything. When that question enters the room, optimization changes. Cost becomes secondary. Speed becomes optional. Redundancy becomes essential. You saw this play out quietly in trade flows. Countries didn't abandon dollar trade. They added parallel channels, local currency swaps, bilateral clearing agreements, gold-backed settlement experiments, energy for goods arrangements. None of these were efficient. That's the point. They weren't built to maximize profit. They were built to ensure continuity. If you've ever run a business, you recognize this instantly. When a supplier becomes risky, you don't wait for failure. You pay more elsewhere. You accept inefficiency to protect survival. That's what states are doing now. And once enough of them do it, leverage weakens automatically. Now, let's bring this back to markets, because this is where the misunderstanding gets expensive. People assume that less dollar leverage means weaker dollar assets. That's not how it works. The dollar can remain strong while becoming less coercive. In fact, that's exactly what's happening. Capital still flows into US markets because they're liquid, deep, and relatively predictable. But the premium for neutrality is rising elsewhere. This is why commodity producers quietly gain strategic importance. Energy exporters are no longer just businesses. Their counterparties, Exxon and Chevron, don't just sell oil. They anchor energy security for countries that want options. That changes how their revenues behave. It's not about growth. It's about indispensability. The same logic applies to mining. BHP and Rio Tinto control inputs that can't be sanctioned out of existence. Copper still moves. Iron still feeds industry. Lithium still powers storage. Settlement can change, demand doesn't. That's why these companies stopped trading like cyclical bets and started trading like structural assets. Gold tells the same story, but more quietly. Not because gold is returning his money, because gold doesn't belong to anyone's legal system. It doesn't freeze. It doesn't reroute. It doesn't ask. Central banks didn't buy gold because they expected to collapse. They bought it because it doesn't require permission. That's the theme running through everything now. Permission has a cost, and assets that don't require it gain relevance. Now, here's the part most people miss, and this is important. This shift doesn't hurt financial intermediaries immediately. It erodes them slowly. Banks that rely heavily on dollar clearing still function. JP Morgan, Citi, Bank of America, they're still central, but their geopolitical risk profile changed. Compliance costs rise, scrutiny increases, margins get pressured, nothing breaks, but the business becomes heavier. Meanwhile, banks and financial hubs positioned as neutral facilitators gain appeal, not because they're more powerful, because they're less political. This is why financial centers that emphasize neutrality quietly gain flows, not dominance, flows. Now let's talk about what people who understood this did with their own capital. They didn't try to guess which country would win. They didn't predict wars or alliances. They avoided concentration in promises. You did that by owning things that function regardless of settlement regime. Energy, infrastructure, physical commodities, logistics, defense. When policy shifted, nothing dramatic happened to you. You didn't scramble. You didn't rebalance and panic. You didn't watch access disappear. That's not luck. That's structure. Others did the opposite. They assumed neutrality was permanent. They concentrated exposure in financial instruments that only work if the pipes remain open. When compliance tightened, friction appeared. Transfers slowed, approvals delayed, costs rose, no headlines, no collapse, just frustration and underperformance. That's how power shifts actually express themselves. Now let's talk about the part everyone wants answered. But no one can answer directly without understanding everything above. Who actually controls the global system now? Most people ask the wrong version of that question. They want a name, a country, a group, an institution. That's not how this works anymore. Control moved from ownership to architecture. No one owns the system the way they used to. They influence it by shaping constraints. And constraints are what force behavior. The dollar used to be the constraint. Now it's one of several. That's the difference. Once you see that, you stop waiting for a new hedge. You realize we're entering a fragmented system where no single lever works everywhere. And fragmented systems reward physical control over legal claims. This is why infrastructure keeps showing up. Ports, pipelines, data centers, shipping lanes. Companies that own these don't care what currency settles the transaction. They care that the transaction happens. Maersk doesn't lose relevance because it gains pricing power because rerouting creates complexity. Complexity is profitable. Defense contractors follow the same pattern. As fragmentation increases, security spending stops being discretionary. Lockheed Martin and Raytheon don't need growth narratives. They operate in an environment where uncertainty guarantees demand. Now here's the part that ties everything together. This shift doesn't end. It stabilizes at a higher level of friction. Once trust is cracked, it doesn't fully return because the memory remains. Every finance minister now knows that reserves are conditional. Every central bank knows that access depends on alignment. That knowledge never disappears. It just gets priced in. And once it's priced in, the system behaves differently forever. This is why waiting for a return to normal is a mistake. Normal was built on unquestioned neutrality. That era is over. The new era is about and optionality favors those who don't need permission to function. In the final part, we're going to bring this to its conclusion. We'll look at how this reshapes global capital allocation over the next decade. Why emerging markets behave differently now, why some currencies survive while others fade, and how investors who understood this early stopped trying to predict power and started positioning around friction. Because in a fragmented world, the biggest advantage isn't dominance. It's resilience. And once you see that, the dollar's changing role stops looking like weakness. It starts looking like evolution. At this point, there's a question sitting quietly in the background. If the dollar no longer commands obedience the way it once did, then who actually holds power now? Most people expect a simple answer. Another currency, another country, another empire. That expectation is the mistake. Power didn't move. If fragmented power doesn't sit in one place. It expresses itself through constraints. To understand who benefits next, you have to understand how constraint replaces control. In the old system, control came from centralization. One settlement currency, one clearing system, one reserve asset that create an efficiency, but efficiency creates fragility. Once the fragility was exposed, the system adapted by adding redundancy. And redundancy always shifts value toward things that still function when coordination breaks. This is why physical reality is reasserting itself. Pipelines matter again. Ports matter again. Ships matter again. Energy supply matters again. You can reroute money instantly. You cannot reroute oil, copper, or grain without friction. That friction is where value now accumulates. This is why companies tied to physical flows behave differently now. They don't trade on optimism. They trade on inevitability. Look at shipping again. Maersk doesn't care if trade is settled in dollars, euros, yuan, or something else. Containers still move. And when routes fragment, complexity increases. Complexity is expensive. Expensive systems generate margins. That's why logistics firms quietly outperform during geopolitical stress. Not because trade grows, because it becomes harder. Energy tells the same story. Exxon and Chevron aren't just energy companies anymore. They're stability providers. Countries don't need cheap energy in a fragmented world. They need reliable energy. Reliability commands a premium. That's why long-term contracts matter more than spot prices. That's why upstream producers gain leverage even when prices fluctuate. Metals behave similarly. BHP and Rio Tinto don't depend on financial trust. They depend on geology. Copper doesn't negotiate. Iron ore doesn't care about sanctions. If industry runs, metals move. And when access risks, supply security becomes political. That political layer adds value to boring businesses. Now let's come back to the question that people keep circling without realizing it. If the dollar isn't neutral anymore, where does safety live? Most people assume safety lies in alternatives. Another currency, another system. That's wrong. Safety lives in things that don't need neutrality. Gold doesn't win because it replaces the dollar. It wins because it sits outside the system entirely. That's why central banks buy it quietly, not for returns, for autonomy. Gold doesn't generate yield. It generates independence. That trade-off matters more when permission becomes conditional. This is also why infrastructure assets quietly gain institutional interest. Pipelines, ports, power grids, data centers. These assets don't care about politics. They function because they must. And because they must, capital flows toward them when trust erodes elsewhere. Now let's talk about what individuals who understood this did differently. They didn't try to become geopolitical analysts. They didn't predict which alliance would fracture next. They did something simpler. They asked, what still works if trust declines further? That question eliminated a lot of complexity. They avoided assets whose value depends entirely on legal promises. They reduced exposure to instruments that only function inside perfectly cooperative systems. They favored assets that produce utility regardless of who's in charge. You did that by shifting away from fragile claims. You didn't abandon financial markets. You balanced them. You added exposure to things that don't need consensus. When rules changed, you didn't need to react. Nothing dramatic happened to you. That's the outcome most people misunderstand. Success in regime shifts looks boring. Now let's talk about the institutions that feel this shift most acutely. Emerging markets. For decades, emerging markets depended heavily on dollar funding. That dependency hasn't vanished, but it's now recognized as a risk. So behavior changes. They build reserves differently. They issue debt more cautiously. They favor trade arrangements that reduce exposure to external pressure. This doesn't make them stronger overnight. It makes them less vulnerable. And vulnerability reduction is the theme of this entire transition. Now let's bring banks back into the picture. Large US banks still dominate global finance. JP Morgan, Citi, Bank of America remain critical nodes. But their role is heavier now. More compliance, more oversight, more political exposure. Their business doesn't disappear. It becomes denser. Meanwhile, financial centers that emphasize neutrality and facilitation quietly attract flows. Not dominance, optionality. Capital doesn't flee the dollar. It hedges around it. That's the pattern everywhere. Now here's the final piece people wait for without realizing they already have it. They want to know what replaces the old system. Nothing replaces it. It layers. The old system remains. The new layers grow around it. And layered systems reward those who understand interdependence instead of dominance. This is why waiting for a single replacement currency is misguided. The future isn't multipolar money. It's multipolar pathways. Money flows where it's allowed. Goods flow where they must, and value settles where constraints are lowest. That's the world forming now. This is why companies that own pathways outperform those that own ideas. Ideas travel freely. Pathways don't. This is also why so many people misread what's happening. They're watching speeches and summits. They should be watching contracts and infrastructure. The real changes don't get announced. They get signed. Now let's end where this began. The dollar didn't lose its weapon status because it failed. It lost it because it succeeded too well. Using a system as leverage teaches everyone how to avoid it. And once avoidance becomes rational, leverage weakens permanently. That doesn't mean chaos. It means adjustment. Slow, persistent, irreversible. The people who struggle are the ones waiting for a moment that never comes. The people who adapt are the ones who stop waiting and start positioning. You didn't need to predict the future. You just needed to remove fragility. You didn't need to fight the system. You needed to understand how it behaves when trust changes. That understanding led you toward assets that function without permission, toward companies that operate regardless of alignment, toward structures that don't break when rules tighten. That's not ideology. That's engineering. And in the world that's forming now, engineering beats optimism every time. The dollar will still be used. The dollar will still be strong, but it will no longer command unquestioned obedience. And that single change reshapes everything. Not loudly, not dramatically, but permanently. And the people who see that early don't panic. They adapt quietly before everyone else realizes what changed.